Welcome everyone. I'm Tyson. This is my co-host Andrew, and we're going to talk a little bit about how to model what we hope are temporary inflation spikes, and also how to model maybe dips in your growth expectations. As you know, everyone I'm sure knows, growth. We ask for a number that is an average for whatever number of years you want to set that expectation. We do that at the account level. And I'm going to make my screen a little bit bigger. Andrew, tell me if it's too big or if it looks okay. Looks okay?
It didn't look like a change to me.
Oh, okay. Well, then that's fine. And let me just quickly, in case there's anyone just getting started with OnTrajectory, I'm speaking specifically about the Accounts, Assets, and Taxes tab. As you know, we have the Income tab, Expenses and Debt, Accounts and Assets. On the Accounts and Assets tab, you get one or more line items per account. So if you've got a brokerage account and you've got a 401k and you've got a Roth IRA, they'll be listed here, and you can model different ranges of years with different growth expectations. So let's say, for example, when you first start OnTrajectory, you've got, I think we default to 4.5% in your pre-retirement years. So in this case, this scenario, from age 40 to R is 4.5%, and then 2.5% from R to 90. I recognize these are pretty low defaults, especially if you're an avid investor. But some folks aren't. Some folks got their money in savings accounts and checking accounts and CDs and things like that because they're don't take advantage of even basic investing. So we don't want to make too broad assumptions too quickly. We hope folks use our tool to educate themselves and dial in what is correct for them. But getting back to what I was saying about modeling dips and whatnot. So this concept of having age ranges is a key element of OnTrajectory. My 401k that I just added, my IRA that I just added, let's say I'm contributing 10% of my salary, and my employer is matching 3%. There, that's quickly modeled. Get that in there. Now, for 401ks, I don't have to model. Obviously, I'm not going to be contributing after retirement. I don't have to add that in manually. What we'll detect when you stop earning, we're going to stop that contribution. But for a lot of accounts, that is a pretty important step. So IRA Roth, for example, let's say I'm contributing $5,000 a year. And I plan to do that up until retirement. So in that case, what I would want to do is add an age range. And this is what I've been talking about with age ranges. So from 42 until retirement, I'm going to be contributing $5,000 a year. And then from retirement until end, I'm not going to be contributing $5,000. And I can, if I want to adjust these growth assumptions, I can do that as well. But what I wanted to talk to specifically was how to model short-term growth changes, or how to model changes across your accounts all at once. I'm going to caveat what I'm about to show you with a teaser. We actually have a new feature coming out. It's going to be called the stressor or something. I don't know. Andrew's heavily involved in our marketing. I threw out stressor just as a placeholder. Are we calling it anything else?
Well, we're leaning towards more of like events, because some of the stress,
yeah,
partly is because some of the things you want to model are positive events rather than just negative events. So they're not, you don't necessarily think of a stressor as, hey, I got a bonus, or hey, I'm going to there's some inheritance I'm going to receive. Now, there may be stress associated with the inheritance process, but
it's not stressing your portfolio.
Yeah. But it's not stressing your portfolio.
Yeah, that's good. I'm glad to hear that, because, as I said, I just threw it out there, and that's a really important point. So what I'm going to talk about here is modeling downturns. But you could also say, what if the market goes on a tear for 2 years and then returns to sort of normal? What would that do to my portfolio as well? All right. So how do I do that? And this is a technique that I actually use in real life with OnTrajectory, I generally have about 3 different ranges with my accounts, with my accounts that count, my 401k or my IRA. So what we'll very often do is have 3 different periods of time. I'll have what I have achieved in the past and have that different than what my current expectations are. And then I'll have a far off, retirement expectation, which is generally more conservative. So let's just use this Roth as an example. I'm going to add another age range. And I'll keep the contributions the same. But what I want to model is, let's say, up until now, I've achieved 7% or 8%, which, before this year, that was not out of the realm of possibility. So let's say from 42, what am I now? Okay, so we start this account at the beginning, both of these accounts at the beginning. So let's say from 40 until I'm currently 42. I'm not currently 42, I wish I was. And then from 43 to 67, or R, I'll just use R in this case. And then from R until the end. And maybe I'll put 3% here, and I'll put 5% here. And let's say I've been achieving 7%. Now, what's really cool about using this technique, if I set up my bigger accounts, if I set them up with this sort of overlay, then what I can do is when I turn 43, I just go in here and I say, okay, I'm now 43. Boom. This updates to 44. So I've got my middle term expectations set. I've still got my long term. And then I can go back and say, okay, what did I add since I started OnTrajectory? What did I average? Maybe 7.5, maybe 6.8. I mean, you can really dial this in really well. And of course, what this does is this helps keeps your assumptions and your progress close. Now, if that's what I do under normal times and I want to stress my portfolio, I can simply add a new range in. Now, this is until that new feature comes. When that new feature comes, I'm going to talk about how it works, but we've already got it implemented for inflation, so I'll talk about it when I talk about inflation. So how would I do that today? Well, all I would do is say, okay, age ranges, they're my best friend, right? I'm going to come in here, put another age range. I'm going to leave my contributions the same. This one's going to be, let's say I'm 42. Oops, not 2, 42. Great.
You have made it a long way.
Yeah.
242.
Yeah. All right. 40 to 42. Let's say I want to build in 2 years of 0 growth. And then from 45 to retirement. So again, this is a way to manually, very directly add this in. We're also going to be coming out with a feature right now. 0's the lowest growth. We're going to have the ability to put negative growth in it as well if you want to put like a shock to your we're going to do that through the tool to the system. Okay, so real quickly, and this is a really just key thing in general. Age ranges, modeling growth expectations. But I also mentioned when I started this, I said there's also a way to do this so that you can, because some people have got 10 or 12 different accounts. And so, you don't want to have to go in here and necessarily create these age ranges or create changes to growth assumptions on 12 different accounts. Let me put just quickly an age range in here. This is 42. Oop. All right, add age range 40 to 42. So now this is a way that I can right across the board make an adjustment broadly, and it's only going to affect age ranges that are future. So if I've got things defined that happened in the past, I obviously don't want to I probably dialed them in, so I don't want to change them. So this is for things that are going on in the future, and this will only affect investment or cash I should say investment accounts. It won't affect home equity accounts. So what I can do is I can say, okay, everything across the board down a half point. I think, is it a half point? Let me see. Yeah, adjust growth across investment up or down by 5%, up 0.5%. Only ranges with future end ages will be effective. So I can just broadly make those changes. So you see these all went down, the future ones. Okay, that's growth. I will pause there, and just in case Andrew has anything in the Q&A or anything that's specific to growth and modeling age ranges.
I think one thing, just as a touch point, would you suggest naming those ranges? Because like right now it says a new range. I think James threw a feature idea, which I replied in the chat, similar to I think how we're thinking of this events and stressors. So as you explain it, but one thing you can definitely do is actually give these age ranges an actual name to them. And the other thing, Tyson, maybe is, can you or should you ever, if you want to just toggle these on and off at a moment, can you hide them or from the chart display, or exclude them from calculations? Being able to do that, is that a wise use of this feature or not?
Well, with accounts, you can't. You can either exclude an entire account, or not, because accounts need a contiguous age range, because we can't have gaps, right? You're not closing the account and reopening the account. So that wouldn't necessarily do it. You'd have to come in here and make changes. But for income and expenses, you can exclude at the range level. Was that everything in that question, or was there more there?
Yeah, no, I think that's helpful. Yeah, I think as we get into more of the stressor events, we'll revisit this question. There is a question in here that just popped in that basically asking, can you break down your account's growth into yield and capital appreciation?
Yes, you can. So for accounts that are, let me add a new account. Add a brokerage account here. So for accounts that are modeled with a tax handling type of annual, you can dial in that kind of those kind of growth differences. So brokerage account, by default, the tax handling, click here on taxes, is tax deferred gains only. And what that means is I'm only going to assess taxes against my growth when I pull money out. Now, if I change that to tax annual, it gives me the opportunity to dial in my tax handling a little bit more by defining a dividend yield. So what we'll do, if you define annual, let's say this is 4.5%, but my dividend yield is 2.5%. Now, what that means is, from our perspective, what we're going to do is 2.5% growth, we're going to tax annually at your income tax rate. Anything excess that is beyond the 2.5% that you've defined as growth, we're going to treat as gains that will be taxed when you pull the money out. So in this case, with 4.5, it'll be 2.5% taxed annually, and then 2% will be taxed when you pull the funds out. 2%, the growth. The growth will accumulate at 2%, and that will be taxed at the gains rate.
Gotcha.
Should I move on to inflation, or?
Yeah, let's move on. And perfect. That was a helpful answer. And then we will. There's a couple of ones that are stacking that we'll pick up on the back end that are similar but different types of questions. But let's keep modeling the stressors stuff, and okay, particularly inflation at this case. And then we'll revisit. One quick question, actually. Sorry.
Sure.
Growth, nominal or real growth?
Nominal.
When you're perfect.
We'll take care of inflation. So just put your nominal rate in, and we'll burden it. We'll burden it. We'll grow it, but then we have a central inflation rate, which converts from tomorrow's dollars to today's dollars. Okay. So let's talk about inflation, since we just sort of talked about inflation. So there's a central inflation rate that OnTrajectory has, and we're going to grow your income, your expenses, and your contributions at the central inflation rate. And we're also then going to burden all of those with that rate when you view any output data or you view your chart. What does that mean? That means that everything you see in OnTrajectory is in today's dollars. So $50,000, whoops, let's go over here, income, $50,000 from this year until retirement. If I view my output data, when I look at income, it's increasing at 3% per year, but it's also being, today's dollars are being translated back 3%. So it's going up 3% and back. So that means when you look at it, it looks like $50,000. If for whatever reason, let's say you're at a period in your life where you're making raises, more often, and you're banking on at least a 5% raise for the next 5 years, you can override central inflation by saying, okay, so from 40 to 45, I'm going to have one set of rules, and then from 45 to retirement, a different set of expectations. So in order to see the growth override column, you have to enable it. So go to Edit Columns, Growth Override. And so let's say 40 to 45, I'm going to grow at 5%. And then from 46 until retirement, just use the central rate. Now, the only trick on this is that, we just put 50 in here because that's what was in the line above. But guess what? You're outpacing inflation by 2% per year. So this $50,000 in today's dollars is not correct anymore. What value do you put in? This is actually a manual step. Just pause here, and you can see that in today's dollars, at age 45, you'll have, in today's dollars, 53,000. So ideally, that's what you'd want to put in here, 53,000. And if you look at the output data, what you're going to see is from 40, I guess, where am I going to put that range? It started it was 50, 50, 50, and then it started outpacing inflation, 51, 52, 53, and then stayed with inflation again because of being nailed to that central rate. These are normal parts of OnTrajectory, just kind of bread and butter. A relatively new feature is the ability to model an inflation spike. And this is what our new, not stressor, what do we call it?
Events is where we're leaning.
Our new event tool is going to allow you to do. And there's 3 major events that we're going to be modeling for: inflation, temporary inflation hits, temporary salary hits. So you could say, oh, what if I lost my job next year, without having to go in there? I mean, obviously you can model that in OnTrajectory. I can create an age range. What if I lost my job next year, and then pick it up? This is just a way to do it automatically and kind of temporarily. And then the third one's going to be growth. So drastic changes to growth for a certain period of time. So the way you'll use this is instead of being stored here under inflation rate, we're going to have a new home for it. And we'll be able to model a new rate, a year that it starts, for a number of years. So in the case of inflation, let's say we're going to put 8% inflation starting in 2022, and it's going to last 2 years. Now, what this is going to do is this is going to grow all my expenses at 8% for 2 years, and then return it back to the central rate. And you'll actually see that in the output data. The important thing to understand is it's not going to grow your income. It's not going to grow your contributions to your accounts. So this is strictly an expense. So you can get a really clear idea of how that hits your ability to achieve your goals. In this case, it knocked me into negative territory. I will also say, and this is a pretty neat feature, that when we have the events thing done, it's going to automatically create a comparison line on the chart. So you don't have to remember what it was. In this case, 8% for 2 years. In order to return to see what it was before, I would have to clear it. And you can see if once I clear it, my projected end balance was $90,000. But when I had the 8% for 2 years, my end balance was negative 180,000. Now that's pretty stark, 8% for 2 years. What about for 1 year? Okay, negative 53,000, because I'm cutting this a little bit, cutting this profile a little bit close. So what would this look like in the future? What we're going to do, let's say, again, I have to do this manually right now, but what if I wanted to make a copy of scenario 1? And in my copy is where I have my inflation. And in my original scenario 1, I want to remove my inflation. So I can see I have temporary inflation enabled, temp. Click on temp, clear it. So what would it look like to compare the two? And again, this is what we're going to have automatically in the future. This comparison tool is pretty new. You can, for any of your scenarios, you can compare them. So I'm in scenario 1. I want to compare it to scenario 1 copy, hit apply. And now I can see them both charted with the results of what is the difference of that 1 year of 8% inflation. And what's really, really neat, and for clarity here, I've also got my progress line is here. I'm going to remove my progress line from my view. Views, remove progress. Okay, so these are my 2 lines. What's really neat about this is I don't have to use this to toggle in between. I can just click on it, and now I can make changes to scenario 1 copy, and I can click back to the original scenario 1 and make changes as well. Okay, so using age ranges to model growth assumptions, modeling either income or the growth override works the same for expenses as well. If I want to healthcare or college or something like that, and I want to model that inflating at a different rate, I can do that, or I can use the temporary inflation adjuster to burden my accounts. All right, I'm turning it over to the group. It's 11:30.
Perfect. Well, that's really helpful. Hopefully most of you guys have been able to experiment a little bit with that scenario view as well. But we've found that the more we show that to folks, the more that they're going, man, that's a super helpful way for me to get actually at the answering the questions that I have when I'm trying to compare some things. So let me, again, I'll highlight, if you have questions, we got a couple of them in the Q&A right now. If this has raised a question for you, or you've just had one that's been itching, throw it in the Q&A. Right now, we're going to ask one, first one that came in. Interested, this is from Daniel, interested in how to best model a fixed index annuity with an income rider. The funds will be withdrawn from a traditional IRA account. Then lifetime monthly income will start in the future, say 5 years into the future.
Yeah, so this question does come up from time to time. And if you can model it super accurately. You could go in here, accounts, and here's well, let's just create a dedicated IRA. And you can grow that IRA, and you can model contributions to it. And then on the year of that you're sort of turning it over to the annuity company, I guess, and the income is going to start, it's not enough just to put the end age. So let's say that starts at age 60. I don't know. If it started at age 60. What happens to this money, all this money that you've accumulated, go into your default account. And so it's still there. So to show it both as money in your default account and as income is kind of double dipping. Now, maybe that is correct, or maybe you can leave it here in the IRA and then show income coming in. But if you need to like show turning it over to the annuity company, you would have to put an expense in there. View output data, accounts. Where's that? Oh, I never contributed anything to this IRA. Hold on. Let me put some contributions in here. Okay. View output data, accounts. So I'm rolling it over $100,000. Now, again, I would probably need to set this to tax exempt because I'm not going to pay taxes on my gains when I roll it over. Or you could just model it as income, which is what I typically recommend folks do with annuities. But it's entirely up to you.
So that brings up some of these questions like that, which, like you said, can totally do it. We maybe we're working to build out our YouTube channel and a couple of videos on from basic to all the way to advanced. So we can pull some of these deep cuts into kind of a deep cuts album, if you will, on YouTube that is like, hey, when you're really starting to unpack how this works, you can get an easy walkthrough, as easy as it can be on a. Oh, so that would be good. We'll take this and put something together, and in the next couple of weeks or so, we'll have something that we can release onto the YouTube channel that models some of these questions, just so that you can go back and reference it. Because I'm sure, as like Daniel, even you're like, okay, that might make sense, but you'll probably want to jump back and reference it. So we'll work on some of those as we go, for sure. As everybody who's tried to do their own taxes knows, it's getting into the mix of some of these things is complicated, but that's why it's nice to have a tool like this, for sure. Let me ask, here's another question. It's come in. With many people transitioning careers these days, how do you model leaving one employer for another, since the age maybe stays the same and you have a new salary, but you keep the former company 401k without a contribution, and then you have a new company 401k with a new contribution and match?
Yep. So if as long as you're so you can model rollovers, you can change. So let's just take that exact situation. So I had this 401k and I'm going to a new place. If I'm leaving this with my employer and I'm just not contributing to it, then I would just go in here and change the contribution. So in this case, so let's say I'm quitting this year 42. I was doing 10%. Go in here, change my contributions now to 0 and 0, and I'm off to the races. I'm done. I'm good. But now I have a new account. So I just create a new account out of thin air. I just go new 401k. And there it is my new 401k. And it doesn't start at age 40. It starts this year at age 42. And I'm going to be contributing going forward my 10% and my employer match 3%. And let's say it's a different salary. So I want to model a different salary as well. I'll come back to this here. Let's go to income. So I want to, for history's sake, I want to keep this old salary in here. It ended at 42. I get rid of this age range, and I got a new salary, new better salary, new awesomer salary.
That's the goal, baby.
Is this not in regular? Okay. My new job, my new awesome job.
Yeah, it's regular income, not awesome income.
And I'm making 75,000 from 42 until retirement. Whoops. Until retirement. And then I just go back to my accounts here. My new 401k. And attach that contributions to my new awesome income. And I'm done. Now, if you want to model a rollover, let's say, because this happened to me. Actually, I wrote this feature into OnTrajectory about 2 years ago, because it happened to me. I had with a previous employer, I'd rolled over my 401k into an IRA. And I started a new job, and then I left that position. So now I have this other 401k, and I wanted to put them all together. So if I have a new smaller it's just whatever, another account, and I want to roll it over, let's just call this 401k. This was a 401k. No. Yes, there it is. And I want to roll it over. Okay, so before I go any further, if this is over at age 42, it's just going to put it in my default account. That's true. That's what it will do by default. So we don't know where to put it unless you tell us. So we're going to put it into the default account unless you go in here and say roll over on end age, and then you can choose the account. So let's say, whichever. Let's say there's I had a traditional IRA to roll it over into.
That gives you an idea of how, if you're moving from one to the other, which, by the way, to kind of, well, I'll piggyback off of that, because what you're viewing right now, you also see that dotted line. And one of the follow-up questions was really, hey, can we go back through how we compare scenarios, how the lines and the labels show up? So as you can see right now, because we still have the compare scenarios on, you can see that blue line that's running through here is the old scenario that we were modeling around inflation and everything else. And we've got this, and we've added to our current scenario. And so you can actually see it in like live real time. So walk through a little bit of how you compare scenarios, and just kind of give us that for maybe folks in here who haven't explored that feature.
Sure. Yeah, and it can get, the more things you get up here, the more difficult it can be to distinguish everything. So first and foremost, we show progress when it's defined to the system, because it's important to see where you've been, what you were able to achieve, and then to see the potential impact of that progress over time. So this thin dotted line grows as I define progress to the system. So let's say I'm going to go in here. OnTrajectory thinks I should have on this date $183,000. I should have $145,000 in my default account. I should have $16,000 here, $13,000 here, $2,000 here, $5,000 here. This is all calculated based on the growth rate defined and the current date. The way we do that, so we don't actually calculate every single day. That would completely blow up the system. We calculate every year, but we calculate a beginning balance and an ending balance. And then we just use the Julian date to the spot that's between those two dates and say, okay, I'm halfway through, so that's the number. But we want people to put their progress in here. So let's say in my default savings, maybe it's a brokerage account. I actually, maybe because of the hit in the market, maybe I'm a little bit under where I thought I'd be. So 125,000. In my 401k, let's just say I'm on track. I got 20,000. My Roth, I've got 15,000. My other account, well, you get the idea. You put the numbers in here, and yep, they're all going to roll up and show me my actual progress, what I've achieved. And in this case, let's say I'm pretty close. Let's say I before I was tracking above or pretty close to it, but now I've dipped below. So the green area here, this green area is real life, what happened. And as you use the tool, this is going to create a jagged line. And I often get asked, especially by people that are just starting out with the tool, why don't we just automatically adjust the orange trajectory line to the green? Why don't we rebase it kind of every time you go through? Because it's not reality. Markets can go up 10, 20, 30%, down 10, 20, 30% in very short periods of time. And that can have a very large effect on your end amount. And what you really want to see, I'm picking a different scenario here. What you really want to see, well, that's a terrible one to pick at random.
I disagree. I would love
that. No, it was good, but it's like reality. Who knows the things that I was doing?
That looked like I won the lottery. That was like I put money down on Red 5, and Luke Skywalker made it. So
Red 5. All right. So what we want to see how you're doing. Like you can see, this one was above, then they were below, then they were above. Now they're wherever they are. And by seeing this is what's going to give you the confidence. As Andrew said, someone earlier on the call actually got laid off and then decided with their package, they used OnTrajectory to see if that was going to work for them. You get a really, really sense of peace and well-being by seeing what markets do, and then what your assumptions. And then change your assumptions as time goes by, for sure, but you don't want to change them every time there's a spike or every time there's a dip in the market, which is why we don't rebaseline every time there's a dip or a spike. So that gray dotted line is progress. When you're comparing scenarios, this can get confusing because you can't click on this. It's not clickable like the other scenarios, and it has this dotted appearance, so it looks a little bit similar. So all that is to say, when you're doing a lot of comparison shopping, you might want to turn off projected progress. Now, back to the actual question that got asked. I want to compare. So scenario one, compare scenario.
Let me pause. Wait, let me pause you real quick. Highlight. If you are linking your accounts with Plaid, you don't have to update those accounts manually, because Plaid will actually go fetch just the balance. It does. We're not storing any of your, any sensitive data, but it'll fetch the balance and it'll put it in there so that your account progress does get actually updated in like daily.
Well,
ish.
Well, okay. Let's actually, no, that's a great. Let me just quickly bounce back to that for a second. So when you turn on comparisons, all the scenarios have this kind of thicker, darker line, and unlike the progress, which is the thinner dotted ephemeral possibility of your future based on current progress. And these are all clickable. So if I want to toggle between scenario one and scenario one copy, I can just click on it to get there. No, I just wanted to quickly backtrack with Plaid. So yes, if you link an account to Plaid, so you go in here and link to financial account, what Andrew was saying is absolutely true. When you put, Plaid is a highly secure industry standard for aggregating account data, and they do attempt to provide daily updates to their data. They don't always succeed, but that's kind of what they're aiming at. So when you link, you're going to enter in, it depends on the account that you're linking to, but you're going to enter in your account
username and password.
Username, thank you. Username and password. Some have different ways to do linking. We never see that password. We don't store that password. It's entirely stored by Plaid, and they don't even save the password. What they do is they create an encrypted relationship with your institution. They give us an encrypted key. Once you start linking, you're going to get a little refresh button here. So when you come into OnTrajectory and you hit refresh, we're going to pull the last daily balance from Plaid. If for whatever reason Plaid, it's a 2 days old or 3 days old, that's going to show in a tooltip. So you're going to put your tooltip over here and it's going to show you the last time. We're going to flag it. If it's more than, I think, a week and a half old or 2 weeks old, we're going to turn it red just to let you know this is kind of it's not the freshest data. And you can either try manually refreshing again, but we're going to leave it red if it's still not refreshed. And Plaid does from time to time. It has hiccups. It's just, I wish it weren't true, but it is true. And in some cases, you might have to unlink and relink your account. It can happen. But that daily balance will try to pull every time you click refresh. So every time you click refresh, that's what's going to create that jagged line or entering in, or a mixed bag. You can have some accounts linked and you can update some manually as well.
Yeah, I found it super helpful. I just kind of have a regular rhythm of once a month. I just go in, I update all my accounts, I see where I'm at, which actually, I did it the other day and I was like, okay, I'm actually not nearly as stressed out as what I thought I would be after looking at it, going like all things considered, I'm gonna make it, even if this thing stays a little crazy for a little bit longer.
I wrote an article about a month ago about growth rates, specifically because my wife said, "Hey, how are we doing?" I'm like, "I don't know, I don't want to know." But anyway, read that article. You can see I did end up.
That's right. It's the new emoji.
Right.
New emoji.
All right.
So we were talking comparisons.
Okay, yes, and it can be more
scenarios.
Than one. So now, unfortunately, I don't know these can be some really crazy things that I've done for
test cases and things.
Test cases, yes. So they might not even be the same age. Which when you compare two scenarios not the same age, it looks kind of weird, but yeah, I'm just going to put them on here. So you can have, 3, 4, you can have multiple accounts here. You can click between them. And they show up here on the right side, so you can see, oh, this is scenario 1, but I'm also looking at new client and scenario 1 copy. Give them better names so you know what you're looking at.
Well, and so to that point, I think one of the important features is there's the copy scenario.
Mm-hmm.
So you can take your current scenario, maybe you have your default, this is like the scenario I run off of, and now I'm going to create a copy of that scenario so I don't have to re-add all of my accounts and incomes and expenses. I just want to model something like, what if I have, we're going to have another kid, or, how are we going to care for aging parents? Like, it's now me and my brother are having this debate about who mom's coming to live with and what does that mean, or how do we have to provide for that? And so that's how you can model that onto your current scenario. The other thing you're able to do is just create a whole new scenario from scratch, right? So you can also create a whole new scenario, which is why Tyson's saying, oh, I've got some with different ages and different start ranges, because if you create a whole new scenario from scratch, you can actually adjust things like base age range. An example of where that might be helpful is what we've had in conversations with folks is they ask a question about when I'm doing everything in my account and I try to add my spouse in, sometimes I feel like, because we don't have the same age, I get confused about, is it my age or is it my spouse's age that I'm looking at? What's happening here? So an example of why you might actually create a new scenario is you might create a new scenario that's similar to your own, but based on your spouse and their information. So you guys can see, that might be an example of a way you want to use a brand new scenario in that sense.
But just to be very clear, we do handle different birth dates for different spouses in the same scenario. You don't have to.
Sorry.
I don't want people to think, oh, everybody's the same age. No. So if you've got, income, I got a spouse, my spouse, the owner of this item. Okay. In this case, they both have the same age. But assuming we do have different ages, let's say my spouse is a couple years older than me. I mean, younger than me, sorry. And I click okay. So now my spouse age is going to be based on them. So, this is my new job. So my spouse's age, she can start at 35. The lowest I can start is 40 because she's 5 years younger than me. And 40 and 35 are going to line up as the same. You can see this reflected in the output data as well. So if I click output data, I can see age 45, 35, 41, 36, all synced up in that particular year. Something else you said made a thought in my head trigger, which was, oh, I know. If you want to, for whatever reason, have both all these tabs open. You want to have both windows. I said you can bounce in between them, but let's say you don't want to do that. You want to have like on 2 different monitors on your computer. You can, let me just turn off these compared scenarios here. Uh-oh, don't make a liar out of me. Compare scenarios. It's not here.
Is it on the scenario itself?
Yeah, that's right. That's what they did. Okay. So
is that copy you open?
So it's they moved it because we had these menus are much better than they used to be. So on scenario 1 copy, open this in a separate browser window. And so now I could, on 2 different monitors or what have you, I could go ahead and model these out differently. All right. Back to Q&A. We got 4 minutes.
Cool. I know. Okay. We got one that's still outstanding. So I'll say that we're going to answer this one, which is what's the optimal way to model extra mortgage payments? And so modeling extra mortgage payments, that would be a good question. If there are any other questions, throw them in the Q&A. We'll capture all of those questions and we can still go back and work on answering them. By the way, several of you guys like Steven asked about pension tutorial. I'm keeping notes on that. So this will help us stack the deck for our deep cuts on the YouTube channel and then our beginner stuff as we continue to add more to those spaces for folks trying to figure out how to use.
Yep, very good.
There.
Okay, so home equity is a huge, it's a huge thing. It's one of the most complicated, honestly, one of the most complicated things for us to model, because there's just so many variables, you know, interest rate on your loan and property value versus your equity increasing because you're paying your mortgage. Obviously there's an expense when you have a mortgage. Do we, you know, do we add that expense in automatically? So real quick, in the next 3 minutes, click on home rental equity. And you get this long thing. This is a home equity item. First off, a lot of times when you can model these as beginning in the past. I've been in the house for 5 years, so I want to figure out a way to model my present equity that I've earned from 5 years ago. Or I just bought a new house, but I funded I used all the money from my other house to put it into this house. So you can fund the starting balance with assets from another place, and the reason I mention that is by default, start balances are not funded. If you say, hey, the starting balance is 50,000, poof, 50,000 just comes in. And then starting equity. So if I bought it 5 years ago and I put $50,000 down, let's say I more or less had $50,000 in the property when I bought it, there's that $50,000 we want to show. When I sell it, there's going to be closing costs. We default it to 7.5%. If this is your primary residence, forget about it. But if it's a rental property, you don't want to get the tax benefit when you sell it. So you got to say it's not my primary resident. The loan amount. So let's say the loan was $300,000. It was a 30-year loan. It was at 5%. And I'm in year 5 of the loan. My mortgage is $2,000. And now let's say I'm done, because those are the main fields. And I click OK. A lot of things happen. We got to go back in time. We got to accrue 5 years of principal being paid. We've got to account for growth in the property as well. And maybe you made some extra payments, which I believe is where this started. So let's say I did make some extra payments in the past and I want to model them. Go in here. So the equity principal is growing by the fact that I'm paying my expense, my mortgage. And if I go to expenses, I see there's my $2,000 mortgage, and it's going to be paid off at age 67, or whenever it's going to be paid off. But I want to make extra payments. So let's say I want to contribute an extra 10,000. It's going to here 10,000. And so now if I look at the output data for this account, the home equity. So you see that we're showing this as a defined contribution. Both the accrual of interest, accrual of equity, and the contribution. So I can see I'm paying it off because of the extra. Well, I was a little aggressive here. Because of the extra, I'm actually paying this off at age 53. So I would actually want to not make the contribution until then. And if I remove all of this, and go back to my data. You see, I'm not paying it off until age 66. So that's how you model it. But that's also how you can see where things land and how much of a benefit it may or may not provide.